Afternoon, Chris. Nice to see you today. How are you doing?
Yeah, very well, thanks. Very well. Good afternoon. Happy February. Hopefully, February is going to be not only a better month for general stock markets than perhaps January was, but also a warmer month as well. We are moving into a slightly, hopefully, warmer period of time. We'll see.
Excellent. On that point, then, let's kick off our monthly updates. And yeah, let's talk about January then, because from an investor's perspective, it's been a really turbulent time, hasn't it? We've seen some, quite big daily drops. We've seen a little bit of bounce back. We're still, I would say, slightly behind where we were ending 2022. But what's your take on it?
Yeah, January was an interesting month at many levels. From a stock market perspective, certainly for investors in America, it was a difficult month. Actually, less so for investors here in the UK, mainly because the UK stock market is very centred on areas such as oil and gas and the metals companies. And the commodity areas have been very strong over recent weeks, mainly because of the other main news out there, that there's been a lot of uncertainty involving Russia and Ukraine and related, which has caused certainly a little bit of geopolitical concerns, which always impact stock markets a little bit. But it's not just stock markets that have been under a bit of pressure. We've seen the same in bond markets as well, where actually bond yields have been going up. That means the price is going down. And that's because finally the Americans, the Federal Reserve in America, realizes they have got to raise interest rates. And interest rates is very appropriate because as we talk literally just a few moments before, the Bank of England have decided for the second time in just over 2 months to raise their interest rates as well. We don't have high interest rates in the UK. It's now 0.5%, which I'm sure anybody of a few years, more than 11 or so years old, can remember a time when interest rates were higher than that. But nevertheless, interest rates are going up. And we know the reasons why. There's a little bit of inflation out there. We can see it in our gas prices or gas bills or petroleum costs, or pretty much anything actually in day-to-day life. So there are a few things have been changing. We've got a little bit more taxation coming as well with national insurance and probably other areas over time as well. Just a few challenges which are hurting the financial markets a bit. Is it a disaster? I don't think so. I think it's still very workable. The world is fortunately still recovering. We are moving away finally from the COVID-19 challenges, I believe. But there's still a few issues out there. And so that's why stock markets have been a bit volatile and things like interest rates have been going up.
Great. Thanks for the recap, Chris. Just let's touch on one of those points then you talked about then. So yeah, absolutely. Just before we went on air, as they say, the Bank of England announced very tightly, wasn't it, 5-4, you mentioned, to raise interest rates to that 0.5, which sounds still very cheap, doesn't it? And we were talking about that, historically and over the long term, you'd expect a higher level of interest rates. So clearly it's going to be slightly better news for cash savers, although very marginally. What's going to be the immediate impact then over sort of the next 12 months or so in regards to investors? Should they be expecting, that to impact their pensions and investments perhaps?
Yeah, I think interest rates first are likely to go further up this year. My guess is the 0.5%, the increase to 0.5% is not the end of the game. We'll probably end up at an interest rate between 1 and 2% by the end of this year. Is that a disaster? No. But as you say, it means two things. One is that if you've got money in the bank, you might actually make a little bit of money on that, my goodness, for the first time, possibly in a few years. But the trouble is, or the difference is that we also still have a little bit of inflation out there. And so the trouble is that inflation rate is still likely to be between 2 and 4% by the end of this year. So if you put it all together, unfortunately, still what we call real returns after inflation are still going to be negative for money in the bank. So it's not a time to be putting huge amounts of money in the bank and keeping your fingers crossed. It's actually a time still to be investing, I would say. And my guess is probably the UK market and many other global markets are still going to remain of interest. Profitability by companies is still improving, and that's really coming back to the COVID-19 improvements and related matters. So I think the world is still okay. We just have to accept that we've got things such as higher interest rates, a few more challenges in terms of higher taxation rates, and that means that not every single company in the world is going to be doing fantastic. And that's why what we call active management, that is the careful selection of where you put your money, as an investor makes much more sense and much more importance than it has done sort of overtly for much of the last 10 or 12 years. Is that worrying? No, absolutely not. For anybody with a pension fund, you've still got to be looking at investing in the world's financial markets. But what it does tell you is that you're not unfortunately going to make those wonderful returns of the last 18 months that we've seen since the sort of the peak or initial COVID problems in sort of February, March 2020. Because since then, stock markets have done remarkably well and bond markets too. But what we should expect to see is that there's going to be a few more challenges going forward. But it's not impossible. And it's certainly you're going to make more money as a pension fund investor, I would guess, than you are unfortunately going to make in your bank account, which is still going to be a bit disappointing.
Yeah, obviously it comes down to objectives, doesn't it, and risk tolerance of clients, and always seek advice before investing money. One clear headwind, then you touched on it, just was the issues around Russia, Ukraine. Let's say worst case scenario, differences can't be resolved, and let's say a conflict starts. What is the likely immediate impact? Because it's a common question I've been asked. Are we going to see a massive stock market crash because of it?
You'll certainly see stock market volatility. Stock markets will go down. However, I would guess there will be two immediate shifts. One will be that areas such as gold and certain commodities will see rising prices. That's a normal reaction to this sort of event. And obviously, hopefully it won't happen. And if it does happen, it will be tremendously small in terms of its ultimate impact. But clearly, uncertainty always tends to lead to areas such as gold and certain bond markets, or even the US dollar, getting a bit of a boost in the short term. My feeling, though, is that I believe at the moment it won't occur, on the basis that my feeling is that the aim of the Russians is to try to ultimately get sustainable higher gas prices. That's their big objective. We can see that actually ourselves in terms of how our gas bills are going up as individuals over upcoming months. And I think ultimately the achievement of high gas prices by Russia, by selling into Europe and other places, will be enough to sort of allow them to sort of move away from some of the big geopolitical uncertainty at the moment. As you say, we'll have to see. It's always important to react to events rather than trying to predict them. But I'm hopeful that we'll see further progress. What it does tell me, though, is that making sure you do have diversification in the portfolio always makes sense. And as you said earlier, you've always got to look in the medium term as an investor. You can't hope that you're going to make a huge amount of money in the next few days or weeks, or it doesn't really work like that. Or even worry too much if actually stock markets fall back a little bit, as we saw in late January, quite heavily for a few days. Because it's always important to look for the medium to longer term, particularly if you're a pension fund investor and are looking actually for the future of your pension, which is maybe 20, 30, 40 years time, possibly even more for some people. So yeah, it's not something I worry too much about. I am following it closely, but I believe that if we do see more concerns, what you'll see is actually an improvement in areas for such as bonds and the dollar, but actually we'll probably find out that that doesn't last for that long. And we find that there's a realization that common sense, as with most things in life, ultimately makes a lot more sense for people, particularly when they're looking to create profits and make positive movements over more than just a few months period.
Yeah, excellent. Thanks, Chris. There's always going to be worry, isn't there, when it comes to investing, and there's no such thing as a straight line investment performance, is there? You're always going to see these ups and downs depending on what's going on in the world. So thank you very much. As always, I look forward to seeing you in March and having a recap there. I'm sure if there's one thing certain, we will definitely have something to talk about in March.
It's never boring out there, but that's what makes the investment world exciting. And I think essential, actually, not just for day-to-day life or making money, but for an enjoyment and interest in how the world is changing and evolving. And the good news is the world is always getting better on average over time. So keep our fingers crossed, and I think we'll be okay.
Brilliant. See you next month, Chris.
Yeah.